daily chart on NASDAQ. This portion above this wick, that's the premium sensitivity side of it. If it's bearish, we want to see the bodies stay heavy in the lower half. But if it goes up in the upper half, it needs to show strong rejection out of there. We got that. In addition to that, we also have the upper portion of this wick. So this is where premium sensitivity will manifest. And then again, we're trading up into that as well. And how does it behave? Aggressive, move lower. So notice these annotations. The pink box in the lower time frame charts is this daily SIBI from last Thursday. Okay. This purple box is this volume imbalance. So think of it like this: premium array down to discount array. If it goes below here, it's going to go to the halfway point or try to gravitate towards that of this buy side imbalance, sell side efficiency, which is a suspension block. All right, so let's move into lower time frames now. So we're at a 1 minute chart. Okay, now this is what you're supposed to be doing each day. You're collecting information, you're collecting data. Okay, and when we have large regular trading hours opening range gaps like we have here, we annotate that and we want to get the midpoint or consequent encroachment level. So this is regular trading hours opening range gap. It's shaded in purple. This is 9:30's opening price at Eastern time, and this is the settlement price the previous day. This level is consequent encroachment. Extending that out in the future, you can see how price eventually worked its way down into it. Look at the bodies respecting it there, and then moves higher. We're collecting all of the consequent encroachment levels on the opening range gaps. Moving into the future, it trades up a little bit and starts to come back down in. These are those two respective discount wicks on the daily chart. I graded them. I showed you the halfway point. This is the higher one, and this is the lower one. Okay, so we're seeing that the market's worked its way above consequent encroachment on Monday's regular trading hours opening range gap. Consequent encroachment. We worked up into this area here, and then went lower. Take your attention over to here. See that? Volume imbalance, wick low. This is Monday's first presented fair value gap. Monday's first presented fair value gap is crucial information. You want to carry it through the entirety of the week. You can see how it's being utilized here. Coloring outside the lines is okay. Getting to the high of it here. Consequent encroachment here, and then falls out of bed. Goes down to the lower discount wick consequent encroachment here. Extending over. Here's that drop. Went down to it here. SIBI. Breaks lower. We're working around that midpoint on that discount wick. And then we went down to Monday's regular trading hours opening range gap, consequent encroachment again. Once we get through it, now it's going to act as a premium array. It's having a hard time getting back above. So we create a displacement here, sell side imbalance, buy side inefficiency, trades up into it and breaks down and consolidates a little bit. Moving on over here, move back above that lower daily wick consequent encroachment level. You can see it's being utilized here, fails to go up, drops down, and we're working around that consequent encroachment of Monday's regular trading hours opening range gap. We trade lower here, settle on regular trading hours, and the very next day at 9:30, we open all the way up here. That pink area is that daily fair value gap from last Thursday. That's the SIBI. This is the SIBI low. So it opened right at it. Then we trade right back down into Monday's first presented fair value gap. Then we're using that daily discount wicks consequent encroachment, the higher one. This is the lower one on the daily chart. It trades all the way back up to the low of the daily SIBI from last Thursday. Again, it's that pink area. And here's the regular trading hours opening range gap and its consequent encroachment. So we have Mondays here, Tuesdays here. Moving towards the right a little bit more, we trade down into first presented fair value gap, rallies up, and we start digging into that daily SIBI from last Thursday. Look how it's using all these levels here. See that? And then finally, we get a small little sharp break lower here in the last few minutes of trading. And then we have another gap lower opening right here. So we have Wednesday's regular trading hours opening range gap. That's consequent encouragement. So that's Wednesday. Moving in the future, trades up into that daily SIBI from previous Thursday. We trade back down into Wednesday's regular trading hours opening range gap, consequent encouragement here. Then it starts to move higher. Why? There's a small little portion of the gap left unfilled until we get to here. Move around, gyrate around consequent encouragement, the midpoint level of that last Thursday's sell side of balance, buy side of efficiency. Look how it uses the next octant. This is consequent encouragement, an octant, upper quadrant, last octant, and then it's the high of the daily SIBI. Same way, it's consequent encouragement, lower octant, lower quadrant, lowest octant, then the low of the daily SIBI from last Thursday. So you can see it's a real natural support and resistance when you grade these specific inefficiencies. It removes all the ambiguity of which high, which low, what I use for support or resistance. Okay, so if you're thinking things like through the lens of ceiling and floor, support or resistance, the way I'm teaching grading specific inefficiencies or particular ranges, it will help you with that elementary perspective of price action. We're moving sideways in here. So we're up here doing this, and then we break a little bit lower, right back up to the octant right above consequent encouragement. Again, the shaded pink area is last Thursday's daily SIBI, sell side of balance, buy side of efficiency. We're in the premium side of it, and then we should see a strong displacement lower, and we get that here. Okay, it's occurring in the afternoon session, so here's a PM session sell off, and we trade just outside the low of that daily SIBI on last Thursday. And then we move back up inside of that range. We end up closing here and opening up regular trading hours down here. And that's Thursday's regular trading hours opening range gap, consequent encouragement level. So mid gap level, big gaps this week. So now right away, you should notice that right here is creating a whole lot of convergence and overlapping of very key levels when we're part of a very large daily trading range. So when we're in trading range environments, it's normal for you to see these types of things happen. And where's the benefit in knowing that? That when these start getting real close together in close proximity, not that they're very close in terms of the number of handles, but when they start becoming very close versus like up here and down there, where we open and where we settled the previous day. That's a little wide disparity. But in here, this is kind of close for being where we are in terms of the daily chart. It gives us a basis for what's the highest one, what's the lowest one. There's your range. So if we can be above this, the market's going to be likely to sell off. When we're below it, it's likely to want to rally. But I gave you last week, we're likely to look for lower prices because we're going lower. So anything above Thursday and Tuesday, Monday's first business fair value gap, above the upper half of that discount wick, the higher one. And then here's Wednesday's regular trading hours opening range gap, consequent encouragement. We're really in a premium market. Is what I'm getting at. If we're in these areas here or higher, and we're in that daily SIBI from last Thursday. Moving forward, here's that big gap. And then we drift sideways, and then start moving down and goes right into that daily volume imbalance, the purple one. It rallied a little bit here and went down. Look at the bodies. And then it rallies up and drops right back down in. And then the bodies are indicating that it wants to go higher because it can't put a body on consequent encouragement. We start to rally up, drifting slowly towards these groupings of consequent encouragement of opening range gaps. We have minor buy side here. And notice how it turns right there in the volume imbalance. Remember, this volume imbalance is the higher volume imbalance of a daily buy side imbalance, sell side efficiency suspension block. So why couldn't it just go down in the single candle? Why did it just stop right here? Why didn't it go down into all the rest of the inefficiency? Why did it turn here? Why did it do this? Why is it starting to drift away from here? It's buying pressure. Is it a lack of selling pressure? No, it's algorithmic. So the market moves up into this level here after that run, consolidates, So the market trades one more time down into the volume imbalance. Have a buy side balance, sell side efficiency here. It trades down into it here and then rallies up. And then we settle going into the close for Thursday's regular trading hours. It ends and then we open up 9:30 Friday morning down here. So we have Friday's regular trading hours, opening range gap, consequent encroachment. And we're again close to the daily volume imbalance. And then these are those lines that grade the buy side imbalance, sell side efficiency, or suspension block that this purple area is. This is the highest of the volume imbalance. So we trade down here, and what I wanted to do was I tested to see if I can get a reaction off of the consequent encroachment of this wick and try to go back up into half gap this morning. Ended up getting stopped out on that. And then we went into here and I sold short, figured, okay, it's gave up the ghost. But eventually we turned at 10:45, started climbing higher, and just failed to get right back to the consequent encroachment level. Notice that? Now, is that bullish or is that bearish? If it can't get there and it starts to fall out of bed, it's bearish. So that's that point right here. We trade right back down into that daily volume imbalance, the higher one of the daily suspension block. We tried to run outside of it again, quickly snatched right back inside, hit the daily volume imbalance high, lower quadrant, starts to displace, sell side, and then finally settling down here after hitting consequent encroachment of the daily buy side imbalance, sell side efficiency in the form of that suspension block. And this morning, admittedly, I kind of wanted to see it go up and take out a little bit more of a buy side and then expect it to drop because it's Friday. And if it were to go up to take out buy side and then break lower aggressively, then that cancels out TGIF because we're part of a larger, higher time frame decline or sell program. All right. Taking you right back to Monday. I mentioned this as well. This is a little too smooth. So when you see price action like this is not how markets bottom. They're going to come back later in the week for that. So we're seeing consolidation. It rallies up, and then we're going to look for a Wednesday, Thursday, change in direction and then aggressively move lower because we were bearish and we were told in no uncertain terms last Wednesday into Thursday that we were going lower. And any premium array, any range that's in a premium, any market shift structure shift lower after being in a premium should see lower prices deliver. And we're seeing it pump up in Monday and get up in those upper levels of premium. And here's the market trading below Monday's first percent fair value gap on Thursday. We trade up into it here, lower quadrant. We break lower and we move into a macro. So 740, 810 macro in this area here. Now here is where I'm teaching the chain of custody for price. Okay. When you're anticipating price going to a very specific price level, Monday's relative equal lows, which is Tuesday's electronic trading hour sell side liquidity. In other words, what I just showed in the previous slide, where it was too smooth, I said markets do not bottom like that. The markets want to come back to that. So here we are on Thursday. And right up here, what's the first thing we see? We're at a consequent encroachment level on a daily wick. So something can happen around that because it's a key level from the daily chart. Nobody else is teaching you that. So here we're crossing that with this premium wick. So watch what happens. I'm going to grade the entirety of this high. Why am I picking that? Why am I picking that? I can't use the high of the wick because that's allowed to do the damage. The bodies tell you the real narrative. And this is a sell side imbalance, buy side inefficiency. So anchoring to this candlestick high is more significant for range defining a range that has yet to be delivered. So this is an implied dealing range from this candlestick's high down to that relative equal low from Monday. That's what this line is right here. This wick, when it does this run up in here, it acts as a gap. So this is a gap. and this is a gap. But when we were doing implied dealing ranges, if it's not yet delivered by price, we're just looking at a target or a draw. But if you know where it's starting from, okay, when the inception of the price run begins, you have to be able to define that. You only learn that from backtesting and collecting information like I'm going to show you here. High that candlestick, which is the civvy, it's a body versus this being a wick. The purpose of the wick here is the upper half of that is premium sensitivity. We don't want to see any bodies left in the upper half. Do we, since this formed, do we get a body above it? No. No. But the bodies are staying inside of this civvy. Interesting, isn't it? We finally break lower, and we have several factors in here. We ran above with this wick, and it completely gave up the ghost and traded down and closed below consequent encouragement of this sell sign of balance, buy sign of efficiency. So we have sell sign of balance, buy sign of efficiency. The body tells you the narrative. It's accurate in terms of getting ranges to project them down to a pool of liquidity and defining that candle high to this red line here, 28,701. It's a finite level. We know that it's likely to trade below it for a sell side, but when you're grading a unrealized dealing range, okay, or an implied dealing range where you're not yet seeing price action there, but you anticipate it going from up here down to this line, then you have to go to a very specific PD array where it makes sense on a higher time frame. That's this level here, that pink line. That's the consequent encouragement of a wick that I talked about. And then you have the civvy. It trades up. It wicks. Do we do a projection off of a wick? No, because the wick is a gap that's allowed to do the damage. You got to use the bodies that gets the real volume of the move. So we're going to frame it from this high down to this low. And yes, I'm repeating myself a lot because this part is the most important thing. Because if you do this part wrong, everything I'm about to outline and show you will not work for you. But if you want to learn how to call every individual candlestick and watch how price walks out the narrative when you're bullish or bearish to a very high probability draw on liquidity, this is what you're doing. Okay. Look at these levels here. Okay. So you have the high of the down close candle or the civvy. And the next line is here. And then the next line is here. So what we're going to be looking at is this level we moved away from. And now we went into this one. Okay. So this entire sell side imbalance, buy side efficiency is laying on this upper octant. That means that this civvy is important. You know this as soon as this candlestick closes and this one closes here, that means now we have this as a civvy. So as soon as this candle opens up right there, you know that the draw is those relative equal lows on Monday. And the candlestick's high is where you're going to anchor down to it. So the low of this civvy on this candlestick, let's zoom in here. This candlestick's high right here. Look at the price right here. 28,941 even. Okay. That's this candlestick right there. That's what's defining the low of this civvy, which is a bearish fair value gap. Okay. We're going to go over to this candlestick right here and look what the high of that candlestick is. 28,941 even to the tick. Yeah. It's occurring on a PD array that forms right on the upper octant. That's why this fair value gap is going to be perfect. So when price moves down and comes right back up and hits this, you're watching price action. You're expecting price to react to that and go lower. If it does trade back up into this, it cannot leave a body in the upper half. We move lower, and then we get this candlestick here. It opens, trades up, and falls short. Doesn't hit it. So what makes this a bearish order block? It doesn't touch this up here. So how's that a bearish order block? I don't get it. What's going on? We're at this level here. It's the upper quadrant level. See how it's laying on it right there? It's got to touch or lay on it to validate this PD array to be perfect. So open on an up close candle when you're bearish, As soon as this candlestick trades down through the opening price, it need not close below it. As soon as it does that, that validates this as a change in state of delivery. And any movement back up, like it does right there, that's where you can sell short or add and build a premium entry pyramiding for a larger position to go lower. So you see that there? Okay, so now what we're seeing is the chain of custody and control of price. It's not buying and selling pressure. Okay, this is my algorithm doing exactly how it's coded to do. Every little fluctuation has a purpose. Let's carry on. The market breaks lower after trading up in the bearish order block. We break lower, and now what do we have here? What else do we have? This wick. Now it's laying on Monday's regular trading hours, opening range gap, consequent encouragement. That is a key level. That's a key level. You have to know what they are. So that means that this wick, if we're bearish, if we trade down below it, then the upper half of this, from the close to the midpoint, price should not book any bodies. Look at that. That's going to be able to be measured and anticipated that it's not going to go up here. Bodies are not going above it. They're respecting the wick. Why is that wick being even used? Why is it important? Why isn't this one important? Because it's not touching this line. It's not touching that line. We already have one here as a wick. First, utilization. If there's a wick on that level there, any other wick, like this would be considered a candle with a wick. This is a candle with a wick. Don't use those because we already have a wick here. See that? This line is your next order of business. It trades down and we get right here. This candlestick's low, this candlestick, and the volume imbalance right there. Extend that out in time. Look where the bodies are. Look at that. They're staying inside the candlestick low to the low of the volume imbalance between here. And look at the wick right here. It trades up and then falls out of bed. Drives lower. And then we get into, what is this line right here? That's the 50 level. That's half. That's half of the range that's defined by my bearish order blocks high down to the draw at 28,701. Now, if that's half of that range, wouldn't it be interesting that a fair value gap forms right there and it acts as a measuring gap? Fair value gap here forms and it doesn't close in. That means we should start to see price accelerate, not have too much of a retracement. It can consolidate, but retracements should not be seen. In an ideal situation, it should just drop lower and speed up, or drop, consolidate, and drop harder. Okay, so measuring gap right at the midpoint, and then we drop aggressively. This candlestick's laying right here on this lower octant. So we trade down into this lower octant. That gives us this sell sign imbalance, buy sign efficiency. We're bearish. Do we want to see a sell sign imbalance, buy sign efficiency have bodies in the upper half? No. What happens if the wick can't even touch the consequent encouragement? Is that bullish or is that bearish? Bearish, because it can't even deliver a midpoint of an inefficiency. This inefficiency is valid because it's touching an octant on a unrealized dealing range. Bearishness, we break lower, extend this over here, we start consolidating, which is what it can do. It can do that. We're just not anticipating price having some wild retracements. Why? Because we're below the halfway point, and it should either consolidate and drop hard or no retracements, just keep on going down. So it's just hanging around in here. There's a little bit of a retracement up and touch the low of that. We have a buy side of balance, sell side of efficiency right here. If price can go down through it here, then it should do what? Act as a point of reversal and move lower, hold price lower, that type of thing. And inside this candle, we open, trade up a little bit, and aggressively sell off. And then we try to get back up into this area where it created a little tiny little mohawk inside this right here. Wait a minute. How is this a valid fair value gap? Because it's part of this run on this lower quadrant level. It rallies up, fails to touch the inversion fair value gap. Is that bullish or is that bearish based on the old man's logic? It's bearish. And what happens? Price falls out of bed down into this lower octant. And look what it forms right there on that line. Another bearish fair value gap. If we're in a bearish market in this sell program and we're going to draw down into this level down here because it's relative equal lows on a Monday and we've been held in a premium all week. Now it's Thursday. No bodies are allowed to be in the upper half. Is that true here? So you're telling me that the sellers were in control and buyers couldn't even leave a body above the midpoint. That's what you're telling me? The logic is held up here. The bodies are left outside of this. So it bodes well for holding. Don't get scared. It's consolidating, consolidating, consolidating. It's going to go down there. And we can't get a body in the upper half, and we can't even leave the bodies here inside the fair value gap. So wait, submit yourself to time. If you get scared, if you feel nervous, and you can take off partials, take one off, satisfy that urge. The market then eventually trades down into our target here. Once this was filled and we swept it here and went right back above, I'm carrying that over here, and now it's an inversion fair value gap. And where's it smooth? Right here. So I'll use the order block, the inversion fair value gap, rallied up here, and it moves all the way back up into a premium, short-term premium, and then gives us this little messy area in here until we get through to the PM session. You heard me talking about last week and this week that the last Wednesday 60-minute or 1 hour buy side and balance, sell side and efficiency from last Wednesday at noon Eastern time. That's this one right here. What was so important about that? So now let's strip it down to an actual dealing range. Okay. I'm going to take your attention to this candlestick's high, dropping a fib all the way down to that candlestick's low right here. See that 50 level right there? That 50 level, go over to the left. What PD array lines up right there? That's this. So if I'm anticipating a retracement, I want to focus on this buy side and balance, sell side and efficiency that did offer bullishness here, which validates this as a bullish fair value gap, potentially turning into an inversion fair value gap. Its first utilization, how it was presented the first time it formed, was buy side delivery. That means if it's bullish and it comes back down, it's going to act as you see it do here, send price higher. But if we're bearish and we go down through it, coming back up into it in here, it's going to show, ideally, premium sensitivity. Is not likely to see price go above it. Now, it can flirt and do all these little coloring outside the lines because it's an hourly chart. So you have to look at these levels here from a 4-hour chart, and you're going to just see tiny little mohawks. Okay. 8-hour chart, 4-hour chart, that type of thing. So if you use a multiple of 4 between time frames, like for instance, if you look at a 15-minute time frame, which is a really nice bellwether time frame, 4 15-minute intervals is a 60-minute chart. 4 60-minute candlesticks is a 4-hour chart. So by having these little quirky little rules, you'll be able to blend time frames appropriately and go to the next higher time frame, key level time frame. Here, don't be looking at these candlestick bodies and say, oh, but there's a body outside that. You have to refine it a little bit, okay? You have to get different perspectives. Just know that the bulk of the turn will be inside that, and the bodies are basically illustrating all that. And look what it does right here. Isn't it interesting how it does that right there? Right there, and the bodies can't even leave a laying of an open or close right there at consequent encroachment of that gap of last Wednesday. This one's important because it was used as a buy side and balance, sell side efficiency here, and then failed later in last week. And we were going back up to it. Okay. So that's why it was still important for this week. That's why you saw it behave the way it did. And then price was utilizing it here. And then finally sending us lower, making a lower low than we did last Friday. Is essentially what you see here. This is the PD array matrix. The market trading up to here. And I'm anticipating it trading down to that volume of balance on the daily chart. And if it goes through that consequent encroachment of the buy side of balance, sell side efficiency, or suspension block on the daily chart, and you can see it deliver there. So in my mind, we're going up here to go down here. I'm going to build more on this because this is a very dense subject matter. So what we're doing is we're studying the chain of custody from one PD array to the next. And if the market wasn't rigged, if it wasn't run by an algorithm, these things would not appear. It would be impossible for these things to keep repeating if the logic is not the very source code that makes it go where it goes, when it goes, and how it's delivered. That's the chain of custody of price action. How one PD array, one specific candlestick, and how it's formed at what time and price lends well to causing price to not move any higher. No, you shall not pass. Yes, you should go past. And I'm leaving it into your hands whether you see this stuff as something that's noteworthy. Even if you don't do it right away and you learn how to do it in your own hands, it's fascinating to study. And over time, the hobby of studying it and being fascinated by how precise these things can be, even if you're just looking at it from hindsight, you don't realize it, but you're actually teaching yourself to see it before it happens. That's the repetition of building familiarity. If you're familiar with something like a hunter teaching his son or daughter how to hunt, you start by showing them the snow tracks and say, okay, what animal is this? This is a raccoon. This is a fox. This is a deer. This is an elk. This is a man's footprint. So that way, by recognizing and by repetition, they learn how to track. And tracking is done in back testing. You got to know what you're hunting and how it leaves tracks. And the chain of custody that price utilizes inside of very specific dealing ranges, whether they're in price action or they're yet to be delivered, it's the same mechanism always at play.